Since we're in the middle of tax season, we figured it would be appropriate to run through the most common reasons you will receive a 1099 from your insurance company on behalf of your cash value life insurance policy. Getting a 1099 from your insurance company for your insurance policy causes a decent amount of panic because you thought this was a tax-free account. And while the technically correct terminology is tax deferred and tax favored when it comes to distributions, ultimately what most people care about is I shouldn't have to pay any taxes on this, right? And most of the time the answer is yes, right. That's very correct. But there are reasons why an insurance company might send you a 1099, which have a lot to do with record keeping and paper trails. And we'll go through why you would receive them and what to look out for to determine whether or not you do in fact have a tax liability because of your life insurance policy. First, if you take a withdrawal or a loan from your insurance policy, you will likely receive a 1099 from your insurance company. This is not to report a taxable distribution. It's simply a paper trail accounting of money flowing in and out of the life insurance contract. And the reason insurance companies do this primarily involves the fact that years ago, insurance products were heavily abused by criminals for the sake of laundering money. So the insurance industry has a very sensitive protocol that attempts to create records and paper trails in an effort to root out illicit activity and also disincentivize it. So if you took a withdrawal or loan against your policy and that withdrawal did not exceed your cost basis, you will not have a taxable liability. You'll receive a 1099, which shows the gross distributed amount in box 1, but in box 2, you should see a zero taxable amount or simply nothing filled in. This will verify that you don't actually have a tax liability. But you should know that if you took a withdrawal from your life insurance policy and that withdrawal exceeds your cost basis in the policy, that would create a taxable liability to you in the amount that that withdrawal exceeds your cost basis. So if, for example, you had a $20,000 cost basis in your policy and you had $40,000 of cash value and you withdrew $30,000 from the policy, that would create $10,000 of taxable income to you. This is only true for withdrawals. Loans are not taxable on life insurance contracts. The next possibility is that you surrendered your life insurance contract and your cash value that is received from that is larger than your cost basis in the policy. So normally speaking, your cost basis is the sum of all premiums paid. And if the cash surrender value of the policy that you receive is larger than that sum, then that difference will be taxable to you as ordinary income, provided you've surrendered the contract and received all the cash. You should know that past loan activity could affect the calculation of the cost basis, and also the receipt of dividends as a cash payment on a whole life policy may also adjust your cost basis. Also, some riders don't count towards your cost basis. So the best thing to do if you're thinking about canceling your contract is to contact your insurance company and find out what they have on record as your cost basis so that you can figure out roughly what your tax liability on the cash value will be, provided that it exceeds the cost basis of the policy. Speaking of surrenders, another reason people receive 1099s from the insurance company that does report a taxable amount that seems odd is because insurance companies do have a strict deadline they must follow in most states to process and send the money that is part of your policy when you request a full surrender of the contract. And if the insurance company does not meet these deadlines, they owe you interest on the cash that they're holding onto. This interest is taxable to you as ordinary income. And it is one of the reasons you might receive a 1099 from the insurance company. Another reason that you can receive a 1099 from an insurance company is if you perform a 1035 exchange. Now, a 1035 exchange is a tax-free transfer of the cash in your current policy over to a new policy. But the insurance company will send normally a 1099 to you once you've done this as another record-keeping measure to show where the money went. This, again, will show the gross transferred amount, but have a zero or nothing filled in the taxable box amount. But speaking of 1035 exchanges, if there is a delay in transferring the money under a 1035 exchange, there may be interest due to you from the insurance company that relinquished the policy or the cash. This could be interest that is required under regulatory guidelines for the state in which we're operating, or it could be interest that accumulated by the insurance policy itself. If this cash gets transferred to the new insurance company, normally it doesn't create a taxable event. But if the insurance company instead sends this cash directly to you and you cash that check, it could, in some cases, be a taxable event. Another reason regarding 1035 exchanges for a 1099 to show up and a taxable reported amount under the 1099 is you got the boot. If you have a policy that you are thinking about exchanging via 1035 exchange and you have an outstanding loan and the company who has a new policy you'd like to buy will not allow you to transfer that outstanding loan through the 1035 exchange, and you decide that you're simply going to surrender some of your cash value in the policy to pay off the loan and then transfer the policy, depending on how much time passes between surrendering the cash to pay the loan off and actually doing the 1035 exchange, you may have to recognize what the IRS refers to as boot income. Normally, the timeline is 180 days. So if you wait past 180 days, you probably won't have boot income. There are others who advise you should use an even longer timeline than this just to be safe, because this is one of those areas of the tax code where we don't have crystal clear guidance on what the exact timeline is to avoid the recognition of boot income. And in essence, the definition of boot income, in specifically the case of life insurance, is the amount surrendered to pay off the loan being viewed as a LIFO, last in, first out distribution, because you are doing it as a provision of the 1035 exchange. Now, if the company that is going to issue the new policy allows you to carry the loan over to the new contract under the 1035 exchange, or you decide to take money outside the insurance policy, wherever it is, and use it to pay off the loan and then do the 1035 exchange, none of the boot income rules apply, and you will not receive any taxable reported income by affecting the 1035 exchange. Another reason you'll receive a 1099 and a reason you would receive a 1099 reporting taxable income is if you're taking the dividend on a whole life policy as a cash payment and the sum receipt of those dividends exceeds your cost basis in the policy. This is much more common on policies that are paid up, because when we have a paid up policy and you're receiving the dividend as a cash payment, you are reducing each year, or with each dividend payment, your cost basis in the policy. And eventually, your cost basis could go to zero, and at that point, all future dividends received will be taxable as ordinary income. It is theoretically possible that even if you're paying the premium still, the payment of dividends could get to a point large enough where they reduce your cost basis to zero, but I am unaware of any situation where this has happened, and that would be extremely unlikely. So this is much more commonly a concern for somebody who has a paid-up policy and is choosing to take the dividend payment each year as cash. Also know that insurance companies normally allow dividend option changes once per year at the anniversary date. So if you discover that you have reduced your cost basis to zero by virtue of taking the dividend as cash, and you want to change your dividend option, you might have to wait till the next policy year to do it, which means you might receive one more dividend payment, which you'll have to recognize as ordinary income and pay taxes on it in the meantime. And on the subject of dividend options, another option that would create a taxable income for you and issue a 1099 is if you take the dividend option to accumulate at interest. This takes the dividend payment and puts it in an interest-paying account. You can withdraw money from it whenever you want to, but it will earn interest on whatever the sum in the account is. It's not a very common dividend option these days, but it does still exist at all of the major mutual insurance companies that are issuing dividend-paying whole life insurance. The interest that is earned on these accounts is not part of the life insurance policy. It's not part of the life insurance cash value, and therefore it doesn't benefit from the tax-deferred status of accumulated cash. Another reason you'll receive a 1099 from the insurance company, and this one would be taxable to you, is if you use a premium deposit account. Some companies allow you to write one check that effectively prepays several years' worth of premiums. And the interest that is earned or credited to these style accounts is taxable to you. But you should know that these accounts work in one of two ways. Some will pay interest on a sum of money while the cash is being used to pay premiums over several years. Others will take a lump sum payment for a set number of prepaid years and discount the future premiums based on some interest rate. This is important to note because depending on the method that the insurance company uses for your premium deposit account will dictate when you receive the majority of your recognized income as an interest payment. For the accounts that just take a lump sum of money and pay interest on it while they're paying premiums, you will receive a lot more taxable reported income in the very beginning. For other companies that use the discount method, the interest that will be recognized comes to the discount of premiums, which will be largest as you get towards the end of however many years you prepaid the premium. So the really important thing to understand is if you have an interest paid on the sum of money style premium deposit account, the majority of the interest that you're going to have to recognize will happen early on. But if you have a discounted premium arrangement, then be aware that the interest that you're going to have to recognize is going to increase each and every single year. Another reason for receiving a 1099 from the insurance company, and this one results in a taxable amount that could be significantly larger than you're thinking, is if you lapse or surrender a life insurance policy with an outstanding loan. This throws people off because they often look at their policy cash value reported under the net cash surrender value, and they ignore the fact that the gross cash value in the policy is much larger, but it's encumbered by the loan balance. From a taxable perspective, all of the cash in the policy goes into the calculation that determines what your gain in the policy is. So even if there is cash value that is pledged as collateral for the outstanding loan, it doesn't just disappear from the calculation of figuring out what your taxable distribution from the policy is if it lapses or gets surrendered. Look at this in-force policy as an example. The net cash surrender value is only a little over $185,000. But there's also a $778,000 loan outstanding on the policy. This means that the gross cash value in the policy is over $960,000. That $963,000 is part of the entire cash that has to be calculated if this policy were to be surrendered. Now, there is a $733,000 cost basis on this policy, so that would get deducted from the $963,000. But that still leaves us with an outstanding taxable gain in the policy of over $230,000. So if this policyholder were to surrender this policy and cash out the $185,000 that are available, they would receive a 1099 from the insurance company reporting $230,000+ of income distributed from the policy upon surrender. And depending on the tax rate, in this case, let's say it's effectively 40%, that could result in a nearly $100,000 tax bill. The good news is we have enough money to cover it. The bad news is we're going to walk away from this with far less money than we probably thought. So again, if you're thinking about canceling a policy and you have an outstanding loan, you should check with the insurance company so you understand what the gross cash value amount is, what your cost basis is, and try to get a sense of what your overall tax liability might be if you surrender the policy. The next reason you might receive a 1099 from the insurance company is your policy becomes a modified endowment contract. Now, if this happens and you don't take any money out of the policy, nothing is going to happen immediately. There will not be a 1099 that you receive just because you have a modified endowment contract. You'll receive other communication from the insurance company because you now have a modified endowment contract, but it won't be a 1099. But if you take a loan or a withdrawal from your policy, you will receive a 1099, and this time it will report taxable income, provided that you have a gain in the policy. Because modified endowment contracts do not get to take cost basis out of the policy first, and loans are taxable, recognized the same way withdrawals are. If you have an outstanding loan and your policy becomes a modified endowment contract, that would create a 1099 at the next tax year because whatever gain you have in the policy could become immediate tax liability because of the outstanding loan. Now, you should know this doesn't happen by accident. If you create a modified endowment contract, the insurance company will absolutely alert you and try to convince you to reverse the action that created a modified endowment contract. But it is another reason why you would receive a 1099, and definitely a reason why you would receive a 1099 that reports a taxable liability. The next reason to receive a 1099, which absolutely would carry with it tax liability, is you violate the 7702 test that qualified your policy as life insurance in the first place. There are a number of agents and lay people who think the modified endowment contract test is the only thing you have to worry about when it comes to qualifying as life insurance and enjoying all of the tax benefits that life insurance brings to the table. But there is another and older test that is part of the tax code that you must satisfy as well and remain in compliance with in order to enjoy the tax benefits of life insurance cash values. We refer to these commonly as the 7702 test. When you bought your insurance policy, somewhere buried in the number of pages will be a reference to either the cash value accumulation test, the CVAT, or the guideline premium test, the GPT. This was simply telling you which test was used to qualify your contract as life insurance. And if you violate this test that was used to qualify your policy as life insurance, then you will no longer have life insurance. This will create an immediate tax liability and a 1099 reporting that in the year the violation took place. In addition to that, every year moving forward that you earn anything on your cash value, this will be recognized as ordinary income and will be reported under 1099 and be taxable to you. This too, like a modified endowment contract violation, is not something that will happen by accident and you won't know. And you should also know that most insurance companies won't let you violate this test because at the end of the day, they don't want to be in the business of keeping records for non-life insurance contracts. It's a hassle. And those are the most common reasons people receive a 1099 for their insurance policy. Some will carry a tax liability, several will not. So just because you receive one doesn't mean you should freak out immediately and think something's going on. There are numerous times the insurance company is going to issue a 1099 simply to create a paper trail that records money leaving the policy. But if there is a taxable amount and you're not sure why, you can always reach out to the insurance company to get an answer on why specifically they have issued this 1099 showing a tax liability. It will most likely have something to do with one of the reasons we've mentioned here. And until next time, happy tax season. Hooray.